Hey guys, and welcome to another video. Today we will be looking at Broadcom stock with the ticker symbol AVGO, which is a semiconductor manufacturing company like Intel or AMD or TSMC, for example. It's, I think, similar to Infineon, which is a German chip manufacturer you could look at. I think Infineon even has better growth potential and a lower price to earnings ratio. I will probably cover it in another video because it's an interesting stock, but Broadcom is also interesting. I don't really know which kind of sector it's really concentrating on. Like Infineon is, for example, concentrating on car manufacturing and car chip manufacturing. I think Broadcom is more in the sector of chips for routers and network related devices, I think. But you would have to look that up. So first we'll look at the chart and we'll see that it's not really at a discount right now, but it's rather at its all-time high almost. Its all-time high would be $921 and it's $100 below that, around that area. But let's now look at the financials. So first we will look at the market cap, which is really high in this case, 340 billion. That's a negative for a so unknown company, I think, because I don't know if Broadcom is that international. To be honest, I've not really heard that much about it in Europe, and I'm also really concentrated in the technology sector, so it's a bit weird that I don't know their products really well, but okay. Now let's look at their revenue. In this case you can also see with 33 billion of revenue they would have a 10 times price to revenue ratio. But okay, let's first look at the revenue. It's rising every year, but it's almost at Intel levels. I mean, Intel is at 60 billion revenue and Broadcom is at 33, so it won't probably grow that much in the next few years, but it could grow a bit still. I mean, quarterly it's still growing like really much, I think. 7%, 4%, yeah, it slowed down a little bit, but most of the chip manufacturers have. Now we look at the net profit, which is positive and also growing, and the average and the shares outstanding, which are slightly the same. So they stayed the same, which is a good thing. Then we look at the cash flow statements. Cash from operating activities has grown from 3 billion to 16 billion, and free cash flow has grown from 2 billion to 16 billion. So they have almost the same free cash flow as cash flow from operating activities, which is really nice. So depends how you look at it, because cash from operating activities minus capital expenditures, so the money which is spent on factories and stuff like that, is free cash flow. Intel, for example, spends a lot on factories right now, so their free cash flow is really small compared to their cash from operating activities. I think even negative. And now we look at the balance sheet. In this case, we would look at the net debt, which means they have 27 billion of debt, of net debt, and their total debt is 40 billion around that area, and their net income is 11 billion. So they would need around 4 years around that area to pay them off, and their cash flow is higher than their net income, which is also a very good thing. So now let's calculate the value of Broadcom. So we will first put in our desired annual return of 15% per year. Then we will put in the stock name, which in this case is AVGO, the stock ticker symbol. Then we will put in the revenue of 33 billion. Then our revenue growth rate, which would be 3% in the lowest case, I would assume. Profit margin, we will pick the lowest first. In this case you could even pick a lower one than the lowest, but let's pick a really low one, like 9%, which is, I think, a bit unlikely, but we'll just pick that in this case. 9% just to see what it would look like in this case. And price to earnings of 15. Yeah, I think that's reasonable. Price to earnings ratio, yeah, 15, we could say, is reasonable. You could go lower than that, but I think these are really reasonable. These are really low assumptions, which would also give us a buying price of $41. So in this case, with these assumptions, it wouldn't be a good stock to buy. Now we'll increase our profit margin to a more reasonable, what do we have? 12%, let's say. In this case, I would look at Intel's profit margin. And Intel's profit margin is at 25-30 at the highest, so I wouldn't really recommend to go higher than 30. Because Intel is really the main way a chip manufacturer would look like in a few years. So now let's continue. We got a buying price of $54 with our profit margin of 12. Let's put it to 24%, which is like more of the average in this case. It was higher and it was lower, so we'll put 24, which would be 2021 profit margin, which could be seen as high, but it has also increased, so I would say 24 is reasonable. That would be my assumption, and for our revenue growth we would pick 5% maybe, would give us revenue of 53 billion. We could also pick 7%, which would give us revenue of 64 billion. I think 9% would be reasonable to higher in this case, which would give us revenue of 78 billion from 35 billion. And it would give us a buying price of $190, which would still be really low in this case, because the stock is at 800. So let's put in maybe a higher profit margin in this case, 30%, which was the highest. No, it wasn't. Okay. In this case, with 30% growth rate, we would have a buying price of $240, and maybe let's turn up the price to earnings to 20, but I wouldn't really go higher than that. So these are even a bit high assumptions with a buying price of $322, and the highest I would go, I would increase the profit margin to 37%, 34% first, and then 37%, which would be the highest profit margin, and this would give us a buying price of $400 around that area. Revenue would be increased to 12% maybe. Yeah, and price to earnings to 25, and then you could argue for a buying price with these really, really high assumptions. You could argue for a buying price of $650. So with this model, it isn't really a buy. Then I will look at our other model. So here we enter again our stock ticker, AVGO. And then we have to look at the numbers of Yahoo Finance. In this case, we would have a growth rate of 10% for the free cash flow. We will put that in 10%, 5%. Discount rate means the desired annual return of 15%. Then we will terminal value of 15. Yeah, we can also put 10 first. Here 0 free cash flow would be 16 billion. 16 billion, and stock-based compensation would be $1 billion, 1.5 billion. Let's put 1.5 billion. Or was it higher before? Yeah, it was higher before. So they've decreased their stock-based compensation, which is a bit weird, but we'll put in that number. And then for our net debt, we'll put in minus 27 billion. Minus 27 billion. And our shares outstanding are 423 million. Okay, 423. Or just 420 in this case. This would give us the result that the stock is currently undervalued, is currently overvalued, and you should buy it at $369, which would also be the price I would recommend you to buy the stock at, to be honest. With a with a free cash flow, with a terminal value of 15, we would get a buying price of $456. As you can see, Broadcom is a bit overvalued right now with $800. But if you bought it a while ago, let's look at the charts. It was at $400, like in like when it crashed due to inflation and stuff like that. And before it was also underpriced, and right now it jumped up. Maybe because of AI. I don't really know why it's jumped up that much these weeks. Maybe we will get some answers here, like an earnings release or something. Yeah, earnings release. Yeah, I don't really know why it jumped up that much. But like I said, if these numbers sound reasonable to you, your buying price would be $456. I would rather go to 300, to be honest, because Broadcom isn't really that much of a brand, I think, and you should pick brand stocks over classical stocks. Like Cola, for example, has a big brand. It's a bit of a value too, but okay. If you like this video, give it a like, and bye.